Hi, this is Randy Finney with the Right Side of the Chart, and today is Wednesday, May 2nd, 2018. I wanted to go over a few different things that I haven't covered lately on the charts. I've posted a lot of market analysis so far this year. That's because we're not only seeing a big increase in volatility, but a lot of technical developments. It's almost as if, especially if you're looking at the intraday charts, the 15, 60-minute charts, it's almost as if, they've hit the fast forward button on the market. So we have these little micro trends so far this year, bullish and bearish. It's a, active trader's dream, whether you're a day trader or a short-term trader, or nightmare, depending on, how proficient you are with the charts. It could be, a market like this can chop someone to pieces if you don't know what you're doing. If you're not disciplined with your stops and your exits. In other words, you got to get out at the right time on these rips, and you got to get in. Same with the dips if you're shorting the dips. All right, let's just jump forward and we're going to look at only three time frames today. I'm not even going to get to the intraday charts. I'm going to show you a couple things that I really don't believe I've highlighted recently. And of course, this all it meshes in with some of the other market analysis that I've covered recently. I'm going to use some fairly simple um, indicators here and point out a couple chart patterns that I haven't already. So on the SPY, we're starting out here on a daily chart. I'll go to the dailies, then we'll jump to the weekly time frames and then the monthly. So we're only going to look at three time frames on two securities: SPY, which is the tracking ETF for the S&P 500, and QQQ. Those are the large caps. Those, in my opinion, are the market. SPY is more diversified and is more representative of the U.S. stock market, or economy, I should say, as a whole. But a lot of traders, QQQ is chock full of the names that have lifted, almost single-handedly lifted this market to record highs. We're talking about the FANG stocks: Apple, Amazon, Microsoft, Alphabet, Facebook. And although most of those names are also top components of the S&P 500, they're not nearly as top weighted in the S&P 500 as they are in the Qs. So I put a lot of my focus in the Qs. QQQ, it's a great trading vehicle because of those big names and the volatility that tech has. But we would be remiss not to look at SPY as well. And one of the potential things I'm looking at here is this triangle pattern that I've drawn out. Now, I say potential because I only have two reactions so far on each side. And in my opinion, it takes that third reaction to validate a trend line. So you can see up top, the way I've drawn it here, we have two reactions, two on the trend line above, two down below. Either way, something to watch for. And we all know, most of us know, that if we break these recent lows from early February and was it early April? Yes, that's not going to be a good sign technically. And therefore, this trend line, and my suspicion is, and I've said this in the past, I think if we even get close, very close to those levels, within a couple percentage points, we're probably then going to go ahead and quickly smash down through them. I don't think the market will walk down slowly at that point and test those. I think you'll see a lot of longs, exiting quick, a lot of stops getting hit. It's just my theory based on past experience, but we'll see again if that happens. And of course, the bullish outcome here would be an upside break, and this is only a potential trend line now. So try to we'll talk about the near-term outlook or any bullish developments I see in a separate video or under a separate post on the front page of right side of the chart. So now, what we do know is the market is so far only had a correction. We've had two corrections this year. A correction is typically defined as a drop of 10% or more off the highs, whereas a bear market is typically considered any drop of 20% or more off the highs. So we've missed the bear market, definition. Just as we came close to it back in 2015, we had a lot of volatility in the markets, and we just barely missed that. In fact, some indexes like the small caps, the Russell 2000, in many different sectors actually did exceed a 20% drop. But again, the primary trend of the overall stock market, and when you include all the sectors, is still bullish, and we don't have any evidence against that yet. However, I'm going to go over a few things that may tell us that we are if these developments happen, and if they don't, then we're probably going to go up, making some more highs this year, and this great bull continues. So one of the things that stands out here is Despite all the volatility, all the back and forth volatility, you can see that basically we haven't gone anywhere. Here's the year marks right here, the month. So here's January. This is the beginning of the year right here, and that was that rip. I call it the New Year's rally. It really started on January, what was it, 3rd, I think, 2nd or 3rd, whatever the first trading day of the year was, is when that kicked off. And it was a very sharp unidirectional rally, meaning very few red candles. We went almost straight up into late January. And now where I'm going with this is if you look at, despite everything that happened, we're basically where we started the year right now, just a hair below it. So you can say that we've gone nowhere, although that's not a completely accurate statement. We've had some big rips and dips in between, but we're back where we started. My point being, this is sideways consolidation or sideways trading action. It's the market consolidating. And anytime you have a period of consolidation, that tends to act as a coiled spring with the market or a particular stock building energy. So sooner or later, this will break out. That doesn't mean we can't go into a multi-month sideways trading range. In fact, when this happened back in 2015, we went into a nearly 2-year sideways trading range. That was what, sometimes not very often, but you can look up the term. It's called a deer market. When a stock market is neither a bull or a bear, it's trending sideways. They call that a deer market. And that's essentially what we had after that big correction or the couple big corrections back then. And I'll get to those in a second. Now, there's a point that I have here. What this is doing when you're coming off a very powerful uptrend, as we have been, this is the Trump pump back here. This is November. This is when Trump was elected, and you can see the markets blasted off. There was a little sell-off leading into the elections, and just about anybody, whether you live in the U.S. or not, is familiar with what they refer to as the Trump pump, which seems so far to end in this buying climax, is what may be a blow-off top. Only time will tell. But the trend was very strong. Now, here's the thing. When I get to the longer-term charts, I'm going to talk about this. Sideways trading action during a bull trend, even if you're not going down, actually has an effect of turning the momentum indicators down, and they are crossing down sharply now, and that can be a bad thing long term. I'm going to get to that in a minute. You're not going to see it so much here, and what I'll refer to are these are my go-to indicators. There's others I use, but the PPO, price percentage oscillator, very close cousin to the MACD. If you're not familiar with how they work, do a quick Google search. Stockcharts.com has a great resource for both how the MACD works and the PPO. PPO works better, in my opinion, on longer term time frames as well as on volatile securities, or in this case, a volatile stock market with a lot of big price swings. That's where it shines above its close cousin, the MACD. And then, of course, I like to use the RSI. And again, there's other indicators. Many of them you can see parked over here on the side of my chart. I hit a little box and they'll pop up. But these are my go-tos. I'm a firm believer of using a KISS strategy in trading. Use a handful of indicators, know them like the back of your hand. There's nothing wrong with experimenting or temporarily using other ones. I've seen people with 20 indicators on their charts, makes my head spin, and you just can't keep track of them all, and you tend to not you tend to miss a lot of signals there. So what do we know right now? As I've talked about many times over, this indicator, the PPO, can be used in many ways. We can look for divergences to indicate a potential trend change. We can also use the zero line, which is that dotted line, defining a bullish and a bearish trend. So for example, back here, I like to use the 9 EMA, the last of the two, to cross the signal line. When the 9 EMA, or that white line, is below zero, the trend is bearish. At all other points in this chart, you can see here the trend was bullish, and it told us so until right here. So right now, this is one indicator, and it is still below zero. And as I often say, we had a little brief whipsaw here. Nothing's perfect, but as I often say, once you cross above or below zero, that zero line tends to act as support and resistance to keep the trend intact. So you can see the bullish trend, that white line tested the zero line there on that pullback, successful test, tested it again there, tested it there, and tested from above here. It went over it briefly, but it fell back down, and we're still below it. And you can see the PPO seems to be rolling over right now. It's really flattening out, so we don't have a definitive signal there yet, but that's something to watch. All right, so let's keep an eye on the PPO, and now let's look at QQQ. All right, here's a potential pattern on QQQ. What I've done, let me move this away for a second. This is what's referred to as a diamond pattern. It's a topping pattern. Could be a continuation pattern depending on how it plays out. In other words, if we get an upside break. Diamond patterns by definition. Let's see, I'm reading off another page just to quote it. Diamond pattern looks like a diamond, but usually is tilted to one side. And you can see that we have here. This one's slightly tilted. So in other words, you don't have to have a perfectly symmetrical diamond. Does take the form of a diamond pattern. And the most important thing, like any other chart pattern, it can go either way. And you'll either have a sell signal and a breakdown below or a buy signal and a breakout above. There's still plenty of, support or resistance overhead on the Qs. There's plenty of support down below. Well, not a lot, I should say. When we take that out, we only have that April low right there and then the early February low. So it's a lot thinner on the downside. If we get a breakout to the upside, let's see if it's impulsive, and then let's watch these previous reaction highs and see what happens there. So I just wanted to point that out as one potential pattern. I hadn't pointed that out before. And to get the measured target for a diamond pattern, you just take the distance from the highest point down to the lowest point, and then you add that to where it breaks down. So let's just hypothetically say it breaks down here. I just drag that trend line, and then that gives us a price target. Again, a measured price target that takes us all the way down to about 133, 134, about 134. So, and from where we're at now, if that were to play out again, just given measured targets on our approximation, it'd be about an 18 or so percent drop, 18, 19% drop from where we're at right now. So there's something to watch. And just like the SPY, you can see that the PPO, in fact, on QQQ, we never even had a whipsaw signal. It was successfully defended here. At this point in time, again, I'm referring to the 9 EMA, during that sell-off into the early February lows. Qs went on to make another high, which was a divergent high. That's marked here. I've pointed that out many times, but I know some of you are new to my analysis, so I'll often repeat the salient developments in the market. QQQ did push on to make a divergent high. So far, it's been playing out. This trend indicator for the first time, other than that brief whipsaw right there, it looks like we had a slight cross there and a slight cross there. For years, this trend indicator, that 9 EMA, has been above there, telling us the trend by this metric at least was clearly bullish. And now this is nothing even remotely close to a whipsaw signal. We came deep, deep, deep down, well below the zero line, and we still are at this point in time. So we're close to testing it from below. We could even pop up. There's even a little upside to go and still keep that signal line below zero. So that's something I'm watching there. All right, now let's move on to the weekly charts, and we'll just look at a few other things that stand out to me. So on the weekly charts, what stands out? The most important things that I'm watching right now are first and foremost, this uptrend line on QQQ. I've talked on this for weeks now. There's two key support levels. You can make out the 40-day, I'm sorry, this is a 40-week or a 40 period. We're on a weekly chart, so that's a 40-week exponential moving average. That's the same as a 200-day moving average. When you put a 40-period EMA on a weekly chart, that's the same as a 200 on a daily. So you can see how well that red line, has acted as support during uptrends, and it also acts as resistance during downtrends. So and again, a weekly chart, you want to see a weekly close, not an intra-week break. Intra-week breaks are whipsaw signals. You had one there, but we snapped back and closed right back up on the 40-week moving average. Here we broke down a big red candle. That candle closed below. If you zoom into the video, you can make that out. I can maybe do that for you here in a second. And that was followed by, from that point of where we closed below, we dropped about almost 20% on Qs. Now, I will say this, QQQ had a flash crash. It is an ETF, not an actual index. It tracks the NASDAQ 100, but because it is an ETF and it trades, there was a flash crash in both QQQ and many securities that day. I remember because I was trading. That's why the NDX, the NASDAQ 100 index, won't show such a big candle. Your trend line on the NDX will pick up here off the early January 2016 lows, but it will be a virtually identical trend line. You'll see the same story with that 40-week moving average. And the market was choppy then, and that's the case. Usually after big correction, you have this choppy action like we've had now. But when you zoom in, and again, I've said this many times, this trend line, in my opinion, is very valid. We have a lot of reactions on that trend line. The one back there in 2015, I just cut off to the left. Well, we tested it for several weeks here successfully. We had an intra-week break, but we closed back above it there. You can see we've been testing it now for the last month or so here, and you can see we're just one bad day above it. This is a weekly chart. So again, you must see a weekly close and not just a little limp, not just a slight close like we had here, just barely below it on that red candle. The green candle means we closed above it. You want to see a big red impulsive candle, and you'll know it when you see it. It's going to look something like this candle right here, most likely. You're probably, anything's possible, but the Qs right now are holding their own. And again, it's coming off that divergent high. So that's one of the things that stands out to me. And then as we flip on over to the SPY, what stands out to me is, and I pointed out at the time, this overbought reading was such an extreme. It was over 90. And I went back 20 years, and again, I probably could have went back 50 or 100 years. At least in 20 years, this S&P 500 has never, ever been this overbought. That was an extreme overbought reading due to the fact the market had already been in a solid uptrend, and then we had that ramp in January, that blow off top. So what I've pointed out since then, here's that this trend line is comparable to the one that I just showed you on QQQ, and more importantly on the NASDAQ 100, which generates off the early 2016 lows, this yellow trend line. A lot of reactions along the way. And that one finally broke, as you can see here with this candle. That was a stick save, and we got back above the trend line. We broke down there on the week ending March 23rd, big red. Like I said, that's what happens when a trend line goes if it's a well-watched level. However, what came into play was this we'll call that a secondary uptrend line, that yellow trend line off the early 2016 lows. And then you can add this bull market trend line that comes off the bull market bottom or beginning of the bull market, the end of the last bear market, March of 2000. That one comes in, and also that white line has a lot of reactions as well, and that's what we've been dancing on recently. So those are the levels to watch, and you can also see just below this the 40-week moving average also acting as support recently. We've had some intra-week breaks, but for the most part, we've closed back on or above that level. So you have, I really like this setup in trading. Now, I always say this, support is support until and unless broken. So we haven't broken it yet. If we do, and I suspect that we will, and if we don't, then that's great. Bulls defend it, we go on. There might be another, swing long opportunity here soon. But we're in a very, very precarious technical posture in the markets. And I've said it for weeks now, and that's because we've been there for weeks. One bad day, especially a solid weekly close below that trend line, as well as QQQ, and I've said this many times, I would never go all in or heavy short on SPY or QQQ if I don't see both of these two leading large cap indexes break down. I don't care too much about the Dow. It's only 30 stocks. The NASDAQ 100 has all your market leaders top heavy in there, and the SPY is more diversified, over 500 different stocks in the S&P 500 or close to 500, give or take. All right, so those are the levels that I'm watching. And again, the developments were this extreme overbought reading. This trend indicator is still bullish for now, and it appears to be curling. Well, it's actually still pointed lower. Right now, you can see the momentum indicators are pointed lower. And let's wrap this video up by going to the monthly charts. This is really what I wanted to get to and talk about. And then we'll keep this one relatively brief. Okay, there's a couple of things that stand out. First is the RSI. This chart, by the way, that I've put up on the SPY goes all the way back into the mid-80s, 1988 or so, mid to late 80s. So you can see all the bull and bear markets in the last couple decades. And so here's the tops. Let's just look. This is the dot-com bubble burst in early 2000. This was the market top back in October of 2007 with the great bear market that lasted down into the early 2009 lows. And here we are today. Okay, I cleared those lines out, but let me point out there was also technically a bear market. It was a drop of over 20% back here in the early 90s. And you can see now where I'm going with this is they all had something in common. Each of those 20+% drops, those bear markets, they were all preceded by overbought readings on the RSI. And as I say, the RSI or overbought in itself is not a standalone sell signal. At least I don't use it as such, but it is an indication that prices have gotten ahead of themselves. And this is that deer market I was talking about, where we traded sideways for nearly 2 years. The S&P 500 and the Nasdaq 100 just barely missed the designation of a bear market. They fell just under the 20% mark on the big drop off, and there were two really big corrections during that period. But again, so most wouldn't consider that a bear market, but however, it was a period, what I call a deer market, where we traded sideways for a couple of years, and there were some big corrections in between. So not fun if you were long during that period. And again, so you can see that going back over 2 decades, the only time that the stock market on a monthly time frame has been overbought was immediately, at least up until now. We can't say because we haven't had a 20+% correction yet. Was leading up to these market tops. And this one, like I always say, overbought can become, and often does become, more overbought or stay overbought for an extended period of time during a bull market. In this case, it was the divergence that really, led to the top. The overbought readings came, well in advance, and that's why I say you can't use overbought as a standalone signal to short, but it is a reason to say, hey, maybe I don't want to keep adding long exposure at this point, or maybe I want to prepare for the next downturn and start getting my ducks in a row, looking for an objective shorting up. Because as I always say, that is just an indication, as are divergences, that a trend change may be coming. But you get your sell signals on breakdowns of these trend lines. That's where I'm going. So this is where I find usefulness in these, and you can see there that on that trend line, at least the way I have it drawn, we've already broken down there. But again, I had that alternative trend line off the 2009 lows, which has yet to give way. So that's the one we're watching along with the QQQ. All right. The other thing that I wanted to talk about, and then we'll move over to QQQ and wrap this video up. Let's get the RSI out of the way, and now let's focus on the PPO. Again, one of my favorite indicators. And what I'm looking at here are the crossovers. And again, I'm lining things up. The more evidence you can line up to build a case, for a bullish, trend or a bearish trend. And I'm talking, this is longer term stuff now. We're on the monthly charts. I'm not talking as a day trader or an active swing trader right now. I'm talking as a longer term investor, 401k money, funds that you plan to, have in the market or out of the market for, the next 6 months to maybe the next couple of years. These are the sell signals and developments that really matter. So what I'm referring to and looking at are the crossovers, especially these high-level bearish crossovers. So what am I referring to? Well, a bearish crossover is when the PPO line, which is the blue line, crosses over the white line, which is the signal line. And although it might be hard to make out on this chart, I can zoom it in. You can see those, especially you want to look for the high-level ones. But in almost every case, when you get these crossovers, you can see that these sell signals came shortly after crossovers. Some came on divergent highs. But let's do this. Let's make it a little bit easier to see, and that's why you have histograms for the MACD and the PPO. So now what I've done, let's zoom this, just get a little bit funkiness going on the PPO when I do that. There we go. Okay. So now let's do this. A histogram simply represents where these lines are in proximity to one another. In other words, when the PPO line is above its signal line, right, like it was right here, the histogram will be green. The higher the histogram bars, that means the farther the distance between the two lines. So simply when they cross over, when you get a bearish cross, that's when the histogram goes to red. So I'll do is I'll park this out of the way because the histogram is telling us what I wanted to point out right now. It's just a much cleaner visual to see where these crossovers occurred. So now let's take a look. Right now, and today is only May 2nd, so the month is still very, very young. But as of this point in time, we have that histogram, meaning the PPO lines have made a bearish cross. But again, all that matters on a monthly chart is how we close, because if we rally up by the end of the month, we can close this green. But if you'll notice, typically once these PPO peaks, and I'm looking at these big, what I call valleys or hills, forget about the little whipsaw signals. When you have these extended periods at high levels, and then it starts to come down, you usually almost always get a bearish crossover. And now let's just look at what has happened in the past so we can kind of figure out what may happen going forward, because that's all technical analysis is about, really looking at historical patterns in stock prices, recognizing chart patterns that and how they played out in the past. There's logic and reasoning behind all these patterns and trendline breaks, how they work. It's beyond the scope of this video. I don't want to get into that, but what we can do here is just show you what's happened every time that we've had a bearish cross, and we do have one pending right now. So we'll zoom in. I'll zoom in real tight so you can see. Okay, there was a cross. And again, remember, these are monthly candlesticks. Each candlestick is 1 month of trading. But we can see where we closed. So this was a doji. So we closed right on the body where the doji is. And then the following month. So if you waited to the end of the month, I'm not going to play the game where after the fact you try to get ahead. So let's say you waited to that was the December. Then on December 31st, you had a clean, you closed and you had a crossover on the PPO. You could either short or gotten out of the market, and you can see the next month we closed down, and I'm looking at my pop-up box to the left towards the bottom in red. We closed down about 3%. Okay, not huge. Might not have been worth it for you to short or get out of your longs, but in my opinion it was, because if you look at where we went from there, we traded sideways for months and went no higher at the highest point to about not even 2.5%. You can see again, I'm moving the crosshairs. We'll call it 3. It's hard to get this exact. You really have to zoom in tight. Let's just say we went up around 3% over the next 1, 2, 3, 4, 5, 6, 7 months. Then a big correction, and actually more to come. So here's where I'm going from this. That sell signal, if you shorted or got out of your longs, saved you from highs to lows over the next you can see the pop-up box just above the red numbers, 1.1 years. So just over a year, the market dropped 12%. And again, that was that deer market I was talking about. You can see we peaked. And we dropped, we traded sideways going all the way back here. You can see this was that sideways trading range, like I said, that went on for, it was actually over 2 years. You can see the market traded sideways for more than 2 years, ended it back where it was. So, and again, had you used that as a signal to get out of the market, not only would you have avoided a sideways market, you would have avoided losses, and pretty significant losses by the time this thing had run its course back in, what is that? End of February, and with about a 12% drop. So there's one. I'll move a little quicker next time now that you know what I'm doing. Let's just go here, zoom into the next one. So here was a sell signal right here with a crossover, and again, not a standalone thing that I use, but something worth noting. So I'll hold the candlestick there, the crosshairs I mean. End of September 2011, we closed the month right here at the bottom of that red candle, and the following month we were down about 5%. So yes, the market did rally after that, but it got you out. You averted losses from that point. The rest of it was a rally that happened after that follow-through correction. If that go back a little farther, we had a crossover there. This was you can see that at the month ending November 2007. That saved your ass if you would have watched that at that time. And again, nothing's perfect, but as I'm going through this chart, so far there hasn't been one instance where had you sold your stocks or shorted the market when you had a bearish crossover on the monthly PPO. There's not a single instance that you would not have profited or seen the market fall from that point. And again, that's waiting to the end of the month, because that's where I'm measuring from. So in this case, I got to grab let's see, I need to turn that off. Well, we all know what happened in 2007, 2009. I don't have to do it. But if you wanted to know, if you waited just using that signal alone, you were averted, and that's shorting at the end of the month. When the signal confirmed, you averted a 55% loss during that bear market. Again, if you were trading the SPY. Little whipsaw signal there. I'd be remiss not to point it out. So we have to zoom in a little bit. We had a whipsaw signal, and that one may have not played out. Let's see. If we really zoom in, and I think I did this already, if you really zoom in and you look at where we closed the month, it might have been down slightly the following month. Where was I? Yeah, you can see the candles right there. We closed the month there with that doji, and in the following month we went a little bit lower, so it wasn't a get out of the market. And again, it flipped back green at this point. Told you it was a whipsaw signal. As I said, nothing's perfect. So there it is. Go back in time. Here's the the top that came just before March of 2000. We had a red bar there. If you follow it on your chart, and again you measure from the highs to lows, we were down. 2 months later, we had gone lower. Had you shorted or exited your longs there, and of course, had you done it here, yes, there was more highs to come, but we dropped from this point. There was about a 8% or so drop in the S&P 500. Then we kicked up, made a new high. You can see that we went green again and then red. So you could almost use this indicator alone, and I never recommend that. I don't think there's any one perfect indicator. Use it in conjunction with everything else, such as trend line breaks, divergences. But this indicator would have kept you, and I could have made the same case bullish going long when these turn green, and it works just as well, even better on QQQ. So that's what I wanted to point out, guys, is that, and you can see now, even though we're early in the month, this indicator is solidly in the red. Now, why is that? We're only two days into May right now. Well, it's what I talked about earlier in the video. We had such upward velocity and momentum in the market that even a sideways trading market will quickly turn down the momentum indicators. If you think about it, that's you have upside momentum, and you don't have to go down to turn the momentum indicators down, because if you just go sideways from that point, that upside momentum has stopped, as actually, and that's what's turning these indicators down. So if we put on the PPOs, you can see it here, price percentage oscillator. There's that crossover, very clean crossover on QQQ. There's a big red bar. Still, like I said, early in the month. So this could turn green, but from my experience and looking at this chart longer term, when we go back in time, let's get it right here. That's usually not the case. Once the momentum is turned, we've had a lot of green bars for a while. We're crossing over. We had a lot of green bars here. We went down, flattened out a little, and then finally crossed over. And so that's what I'm looking at, guys. So all we need now at this point, the market's in a very precarious position. I'm going to end it here by saying this, that as I said earlier, support is support until unless broken. So maybe we bounce, maybe these indicators close green, the PPO doesn't cross this month, and this market goes on to rally for a few more months and into 2018 and make new highs before we go much lower. However, we are only, and I'm not trying to be dramatic with this, we are only one bad day away. I'm talking about one of those big 5% down days, breaking these levels. And from my experience, when these key levels go, I have a lot of evidence that I've gone over in this video and other videos, those trend lines, the divergences, these indicators. From my experience, what happens at that point, you're going to have a waterfall sell-off. You're not going to have a chance, most likely. I'm speaking as what I think might happen and what from previous experience. If we get down and start to undercut those lows from early February and early April, the selling will accelerate. And if you're long and you're hoping for a kickback rally because you woke up and we're down 3% at the open, a gap down, and then we close down 5% that day. It happens again the next day, and you're waiting. Well, okay, now I see Randy's right. All these trend lines are broken. The selling's getting impulsive. You're probably not going to get that kickback rally back to where you were. So what I'm trying to get at is be prepared. Anything can happen, and I'm not trying to use scare tactics here, but don't be complacent. And if you start to see it happen, start to see those levels go, things can happen quick. So have a trading plan, whether you're bullish or bearish in this market. Have your setups lined up, whether they're shorts, whether they're longs. If you're a long-term trader and you're trying to protect gains that you've made in recent years, respect these levels if they go. And it's better to sell out, in my opinion, on a day that's down 4 or 5%. Nobody wants to sell on that day. But if all these trend lines have gone, the selling's impulsive, and we have sell signals across the board, and you wait for that kickback rally, well, the market might be down 15, 20% before you have another 5% kickback rally. That's a very real possibility. All right, so I'll end it there. Hopefully this is useful to you guys, and sorry about lying about the length of the video. I just looked up, it's longer than I thought, but a lot of stuff here, guys. This is, we haven't seen the markets at such an important technical level in years now. So I think it's worth covering this stuff, and hopefully you find it useful. And if you do, a thumbs up on the YouTube page would be appreciated. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.